Welcome, everybody. A warm welcome also in the name of JFDs here at JFD Brokers. Today, the 14th September 2017, 7 p.m. German time, as usual for my type of webinars. Yeah, my name, by the way, is Stefan Friedrichowski. And if you write me an email, just go directly to Stefan, especially for the English ones here. I think it's a little bit more common, but if you write me in German, you can also name me simply Stefan. My email address you find here on my first slide already, S. Friedrichowski, a really complicated name, I know. So at jfdbrokers.com. And if you don't know exactly how to write that name, I can only recommend you that already now you can download all the slides of today's webinar via the GoToWebinar control panel. And later I will show, as in most cases, some Excel sheets. If you have interest in those, just send an email to s.friedrichowski@jfdbrokers.com, and I will make sure that you get all this, not only the slides, the Excel sheets as well. Yeah, that's for the beginning, but what's the title for today, or what's the topic for today? That's DAX Vola trading strategy. Okay, you know immediately what I'm talking about. So DAX, okay, you know, Vola stands simply for volatility. So it has to do with both one specific underlying with volatility, and you will see that we do a little bit more on that in order to create, once again, a trading strategy. But what I present you today is more basic concept. It's not only one single strategy. As always, I invite everybody to go a little bit deeper here into the development of trading strategies. And what we do today is related to what I call class trading. That sounds like a black box, but it's a very mighty tool, and you will see that that kind of concept can be applied to a lot of underlyings, a lot of different concepts within trading. And it's very similar to what people do in totally other fields, like machine learning for Facebook, for Amazon. All those things are based on classes, but not school classes. That's now another topic. It's real classes, groups of elements, and we can apply the same kind of methodology to trading, and that's quite fantastic because the outcome is good as well. Okay, so that's in principle the topic for today. But before we really start, two things here. One, of course, as always, this risk disclaimer I have to show, and I think it's good that I show that. I talk here about trading strategies. Finally, when you do your own trading, as always, you do it on your own. And yeah, it simply is your own responsibility, whatever you do within trading. The other one is a little bit off topic, simply because yesterday, I mentioned it in the German webinar yesterday, because there it has been really direct. But I want to share this with you today as well, because there was really something funny. When I looked here to gold, so look here, not to the lines and not to the blue box. It's just looking to what happened here yesterday around 12 o'clock, around lunchtime and later. What we look here is an M15 chart with gold, and then when you count those, you see 11 red candles in a row. So 11 red candles in a row is something like a rare event, But as you know, we always look to what we see in charts from a more mathematical point of view. So let's calculate quickly because that we can do direct without a calculator. So 11 candles in a row with one color means if we compare it with random walk, random behavior, like throwing a dice and with only two colors, it means 2 power 11 is the probability, or 1 to 2048 is the probability to have exactly that kind of event. And if I translate that to an M15 chart, that would mean every 22 days you will find 11 candles in a row with the same color. Okay, maybe you would state that's not that rare, but M15 only every 22 days is at least not that often. So it has something to say us, because I would say that is something like a black swan event happening not that often. Um, if you look now to the chart, we realize, okay, after that 11 red candles, nothing spectacular happened anymore. I totally agree. The only thing that's already from today, but that was the two decisions, or at least one decision that was Great Britain having no change in interest rates. Yeah, that's how no change looks like, even if the no change is expected. And funny enough, even the not expected change has had a huge impact on the British pound. But anyhow, that's not the topic of today, really. But just want to mention that rare event we saw yesterday was 11 candles with same color. Okay, back to our topic, DAX Vola trading. So in detail, what we do today is I will introduce the concept of class trading. Class trading means we build up groups of particular or of specific things. I still call them things. Later we will see I use two indicators, and you see them already here on my introductional slide, that we take two indicators. One will be the EMA and the other one will be the ATR. And because of that ATR, the title is Vola trading here today, but there's a second indicator, an EMA, and we don't take that indicator right away. We will look for the slope of a specific EMA. And what we will try to find out whether we find some good correlations that we can build up groups for specific trading behavior within a certain group. And those groups will be defined by group values for the slope of an EMA or the ATR. Think about in terms of medium, high, low, just three groups that will be enough to start with, but later we can do much more things with those kind of grouping. And those groups create one class, and then we investigate each class individual, how to trade that class. And that will help us to find specific situations, and we know exactly what to do with that situation from the history, and we can apply those rules we develop for our future trading. And that is finally the DAX Vola trading strategy. But let us be a little bit more specific here about the concept of class trading. All starts with a statement. And that statement, I think I have made the same statement already the last webinar for a completely different concept, the walk forward methodology of how to get self-adapting trading strategies. And there we made the same basic statement of markets might change. And now we have markets have different phases. I think if you just read that sentence, you listen to that statement, you would immediately agree to say yes. At least all we know, or everybody of us knows that, for example, we have upwards phases, downwards phases, sidewards phases. But even the definition of such a phase might be a little bit more complex, and but those phases can be defined. How? We will see. Immediately there's a consequence. If we think that markets have different phases, then of course those different phases need different trading setups. It can't be that we have one concept for all. If there are really some fundamental differences in those phases, and since I use now the wording fundamental, that has nothing to do with fundamental analysis, like looking to the balance sheet, of a specific stock or specific company. No, with fundamental different trading setups, I mean, maybe we need trading setup with small risk reward ratios, high risk reward ratios, stop loss levels which are far away, stop loss levels which are very tight to our opening of a trade. That I mean with specific trading setups in specific market phases. The challenge now is simply how to identify those phases, and that we have objective criteria how to define such a phase, because only if we have such criteria we can do it always and even in the future. Otherwise, we would just argue something, but that is not really well defined, or only if that argumentation would follow a strict rule setup. But we have it much easier because we can do everything mathematically, and then those phases are extremely well defined. It will become clear just in a few minutes. I will show one example, and that's the DAX daily, and that is the solution for our challenge, how to approach something like that. And what we use, as mentioned, we use two indicators, because then we have a quantitative measurement of the actual price movements, price history, price behavior. And we use simply two things. One, EMA, the slope of the EMA, and the ATR. Both are quite important. You immediately realize if I talk about the slope of an EMA, it might help me to say, okay, price is moving upwards. That would be a positive slope of an EMA, and maybe highly positive, so a bigger number. So that EMA slope might help me to differentiate between upwards, downwards, sidewards. But I use an additional indicator, an additional number, the ATR, because we know from history that there are phases with high volatility. You can always think about the financial crisis, the climax of that, 2008, with extremely high volatility. And of course, those high volatility situations, phases, should and could be traded differently. And therefore, my selection here has been EMA slope and ATR. But let me remark here as well that in principle, that kind of concept can be based on other indicators as well. You might think about an RSI in order to have that overbought, oversold situations, for example. You might even take an ROC, rate of change, momentum, something like that. All those kind of indicators are in principle suitable for that kind of concept in order to create our faces. But how does that look really in not already really in numbers, but just to get a feeling about that concept? So what you have here within that chart, that is the DAX for 25 years now, with the two indicators. Of course, here I have not really used the slope of an EMA. It's an EMA as it is, but we can immediately, with our eye, think about the slope of that EMA as well. So what do we have within the chart? We have in blue the DAX itself. We have in red the EMA. And I think, if I remember right, in this case, it was an EMA of was a period of 200. And we have an ATR, and that ATR is related here to the right-hand y-axis. And what you see already, I use a little bit different ATR than standard ATR in MT4. I use an ATR in a percent value. Simple reason. Why do I not use absolute numbers like we have for the DAX, maybe an ATR of 150 points? Simple reason. If you look back, today DAX is at around 12,000 and started here below 2,000. So if I would have an absolute number of ATR today 150, at that point in time, definitely it would be something like 30 or 40 points. So it would be misleading to have an absolute number for an ATR with respect to an index. Same applies, for example, for gold or oil. In Forex, it's not that important because normally all Forex values are around 1, or if Japanese yen is involved, then around 100. But even there, we have at least a factor of 2 difference possible. So therefore, I prefer always an ATR in a percentage value because then we can look to longer histories here as well. And maybe you realize already that that chart is not that fresh because the chart ends around 2016. So today we are back at 12,000 something. So anyhow, the chart is a little bit older. I think it was November last year. Anyhow, but now let's look whether we can derive already some conclusions directly out of the chart. In principle, we see high volatility phases. That's whenever the yellow line is extremely high. So here we even reach values of 5% that was before 2003, and once again that is a 2008-9 UN financial crisis with those high volatility. But you see, it was before that we have had the same situation already. Right now, volatility went a little bit up, going down as today it's still once again in that low value region here. But let's first focus on those strong upwards moves of the DAX. Here we have one, here we have one, here we have one, and in the beginning we have the same situation as well. So they all have in common, of course, an EMA slope, which is medium or even high, so positive and sometimes even strong positive. Same time, if we look to the ATR in those phases, the ATR in most cases has more or less very low values. Not always, but I pick right now those cases I can identify already with a blank eye. Maybe that is not such a surprise because that is what another indicator or value is telling us. Instead of using an ATR, you might use so-called uh, VDAX, which is a measure of the volatility as well, but in a little bit different way. But anyhow, from that VDAX, you might know already statements like, okay, in bull markets, we have typically low volatility, low values for VDAX and vice versa. Whenever the VDAX or ATR goes to extremely high values, that might be something related to strong down movements. Okay. And you see what we are doing here just by looking to the chart and analyzing with our blank eye here means we create already something which I later will call classes, because I differentiate everything in just three terms, in three ranges: low, medium, high. Or for the EMA slope, I would say strongly negative, more or less flat, and high values, high positive values. And you see, and you know automatically if I have two indicators with three values, three subclasses, finally I will end up in 9 classes. The question now is, if we do it more mathematically, can we find specific classes for specific trading activities? And you will see the answer is yes, as we do already a little bit here with our blank eye, to see, okay, extremely high or high values of volatility. Maybe there's a preference for short trades. Low volatility, preference for long trades. Additionally, input we get from the EMA slope. And that's exactly what we do within that webinar. Let's now do it a little bit more mathematically in order to have really a final view on that methodology. So we use two indicators, and EMA slope, ATR. Okay, done. We will establish 3 classes, as I did it already verbally: medium, high, low. And you may think about what we are doing here to create those classes, to assign specific situations to specific, then later trading activities, is more or less the same than companies like Amazon or Facebook are doing with us, and all the information they get from us, maybe from our buying behavior or from our like behavior, that we can create those classes. And they, by the way, in most cases do a quite well job. So whenever you buy something, for example, at Amazon, then you will later get an email, somebody who bought or who has had interest in that article, maybe this one here might be of interest for you as well. You realize maybe it's exactly the same we are doing now with a stock price or an index or a forex value. It's exactly the same kind of methodology. We put situations, we put human into classes, and we look for common behavior, common features, common buying behavior, and therefore we can create those groups. You may like it or not in terms of Facebook, Amazon, and co, but they are not doing bad with that. What we do here is exactly the same, but our underlying are not humans. Our underlying is a price of whatever underlying. But we do the same kind of methodology. If we want to create now those kind of classes, we have to normalize it. Now, I know whenever I mention that sentence here, you may think, wow, Stefan is crazy. Class separation by normalization of the distribution function. Sounds crazy. It's completely simple. It only sounds complicated, but it's really quite simple. What do we want to do? I introduced already that we want to have 3 classes. Okay, we have a lot of values, ATR values. If we have our 25 years back, then it will be 6,500 points or data inputs, close values, ATR values. And all we want to do or want to achieve is in our classes, low, medium, high, I simply say, okay, I want to have the same number, the same amount in every class. So I want to have 2,000 something in the low class, 2,000 something in the medium class, and 2,000 something in the high class. This and something is 500 divided by 3. Okay, so that is nothing else than a normalization of the distribution function. We could really create the distribution function, but then still we have to separate. And one way of doing that separation is that normalization process. There might be other things like we go for the maximum value, we go for the minimum value, and then we have 3 sections simply by dividing them. Would be something we could do as well. I have decided for normalization. But anyhow, that's meant with normalization of distribution function. It sounds good. Really crazy. But finally, what does it mean? We have 3 subclasses for each indicator. And that means finally we have now 9 real classes. And those 9 classes will be investigated finally. Looking back to trading, that might even be classes like don't trade. So be flat, be outside of the market. And we all know that there are times when it's better to stay outside. So that might be an outcome of this analysis as well, to say don't trade in this situation. So what kind of outcome I want to achieve? It's something like that potential matrix. In this case, the matrix here is not right. It just should illustrate what might be a first outcome of what we want to achieve. You know, we have those 3 classes slope, 3 classes ATR, and then an outcome might be, okay, if the volatility is high and the slope of the EMA is low, we enter a short trade, which would not be in line with what I have done within the chart. But anyhow, if we get something like that system with flat, no trade, green, go long, red, go short, and if you can prove that this has already a probability advantage, then it will help us in our trading activities quite well. We can either use it direct and trade it strict, as it is. Long means long, and long later will mean market opens, we open or trade long, market closes, trade is closed. That would be, for example, one rule. But there might be some other what still would help us to have that information at what point in the matrix and then later in the specific situation, what kind of direction or no trade we should prefer will help us a lot. So that's something we have in mind, what we would like to create. Okay, let's do it really practically. So let's get started here first. So what we have here is, and let me enlarge it a little bit here. So We start with our prices, meaning DAX values starting in 25 years ago, open, high, low, close. And yeah, now it's up to us to create those two indicator values. So first, what we have to calculate is the ATR value. And just that you get a feeling of how that is done, more or less the ATR is an average of high minus low. If you would have no gaps within our charts, then it would be already exact, but gaps make it a little bit more complicated. Therefore, you see a little bit more input here in the formula. But anyhow, more or less, it's just a measure of maximum minus minimum. And then we do it percentage-wise, as already discussed, and the reason why. And finally, in my case, therefore, I have fixed numbers first, and only after 120 candles, I can really calculate that number finally, because I want to have the average of 120 candles, and that is simply done by averaging those true ranges in percent. So that's the definition of average true range. And then finally, we have that period, which indicates us how many candles are averaged. The other thing that we have here in an EMA, is straightforward how to calculate that. You see the formula, and as I mentioned already, you can have those Excel sheets as well. And then we want to create the slope of the EMA, which is done here. And what I do here is something that I average that as well, because otherwise my picture here would be not that would be too noisy. So you see now already in that picture that we get a new line here, and that new line is the green one. I have rescaled that line a little bit in order to have it here on the same scale like the ATR. You see the reason why I use an additional average of 10 already. That green line is still quite noisy. But now it comes to, we have here now the values. We have all the values, slopes and the ATR values. And now we want to do that class separation. But before doing that, we have to normalize what we have here. And how this is done, let me show you directly. So I will take all my values for ATR and copy them into a new sheet here. But now I insert them just by value. And still, you know why we have always the same at the very beginning. That's for the first 120 candles. I have a fixed number here because I'm not able to average at the very beginning of the chart. So what we can do here, of course, we can plot those values, and then we get more or less the same picture we have had in my chart previously. But anyhow, this is how it looks like. And what we simply do now, in order to get that normalization process quite easy, is we sort the values. So we sort them simply by value, and then we get a chart like this. And now we are more or less done. This is something I don't know a better name for that. I call this always a pseudo histogram. I know that is not mathematically correct, but I have no idea how to call that kind of chart here. But it's something like an histogram, and we can directly say where we have to set our separation values in order to get our three classes. You remember that I mentioned we have 6,500 data points. So if I simply go here to 2000, what is it, 2166, that would be around here. Then I know exactly what value I have to apply as the separator for my limit for the threshold for the first class. So it would be around 1.2% about. And then I go 1/3 further here. Then I'm maybe about here. And so at 4,300 something. And that would be 2%. So we have exactly those separator values in order to define our 3 ATR classes. And that's all. And the same we do for the EMA slope. So finally, doing so and getting those separators is what I have done here. Let me quickly show you. I've exactly done what I have done before in the other Excel sheet. I get those two limit values here. This is 1.2%, 1.9%, and those make sure those threshold values make sure that in each class we have exactly 1/3 of our data points. Same for the EMA. And let's have a look to the distribution of the EMA. One remark here as well. Of course, we find more values which are positive than values which are negative. Why? The answer is simple. DAX in average goes north, and that's exactly reflected by the distribution here as well. So don't wonder that we have about 2/3 of our values positive and only 1/3 here negative, which, by the way, means that one separator limit here is around 0 in this case. Okay, we have done this, and now it comes up that we create those classes. And that's simply comparing the actual value of the indicator, the ATR. We compare that value with our two limit values here, and then we can assign those classes like 0, 1, and 2. Let me scroll down here a little bit. So in this case, we have, for example, values, ATR values, which are low. And you see 0.9, 0.9, 0.9, 0.9. And those we now call the ATR class 0. If ATR values went up, then now we have it. We are in the middle class here, the medium one with 1, and so on and so forth. The same we do with our values for EMA. So we do the same kind of logic that we get those three numbers, 0, 1, 2. So we have the subclasses ATR, the subclasses EMA slope, and finally we want to create what I call here the class ID. And that class ID is created by a simple formula. We take one of those ATR, for example, multiply it with 3 and then plus the other one. What does it mean? We get exactly our 9 different values. In my case, it would be the numbers between 0 and 8. And we know exactly if we have a class called 7, then it must be high value for slope EMA, and it must be a medium value for ATR. That means we get exactly our 9 different fields within our matrix, and we have a single number for every class. In this case, it's 9 because 3 times 3 is, of course, 9. And now we go one step further. What we do now And that's already a little bit bigger here. Let me first zoom out a little bit. What we now ask ourselves, if we look into the different classes, we know what kind of change we have on that specific day. So if you look here in detail, what I have done is I look to the previous day, M17, compared with the class number, and in this case, the class number has been a 4. And then I look to the next day, the today day, so to say. What change do I have within that day? And the change, I simply mean close minus open divided by open in order to have a percentage value. So, or even easier to say, is it a long day or a short day? So I get those changes assigned to the right class. And then what I've done further, I have accumulated, I have built up something like an equity curve of a single class. So let's describe it within the chart, and maybe you focus yourself first here on the green line, and be patient. I have a more impressive example later in my next sheet when I change the ATR period and the EMA period. But here, because in order to visualize everything, I have to use those high values of periods, because otherwise we would only see noise, but within that noise is much more information than you expect. But back to the chart. Look to the green line. If that green line goes more or less strictly upwards, what does it mean? That means that class number 7 is a perfect candidate for long trades. That's all. So if we have class number 7, we should trade long. That's the meaning of that kind of equity curve, because on average we have had long moves exactly following today's with class number 7. Same for class number 0. A little bit different is the story for class number 8, because the violet one here is a little bit more going south. What does it mean? Going south? Okay, no problem. We can change the slope of the equity simply by going for short trades. And that would mean class number 8 would have preference to be traded short. And you see already here directly the red one, 1, and that yellow one, 2, are perfect candidates to say don't trade. Don't trade at all. Be flat, because we don't have any advantage, any probability edge into one direction. If we sum up the right classes with the right sign, and sign means short or long, we get an equity which looks like this. Not that bad for those simple rules. All we do is we use the 2 indicators. We have our 9 classes, and we know in what class we should trade how. And the answer finally is within that kind of matrix. So, and here you find exactly what we have had done directly out of the chart, at least a few elements here. If we have a negative slope and a high value of ATR, we should trade short. There are a couple of classes which should be not traded at all, so be flat, and a few cases which should be traded long. Well, most of them are long trades. And of course, we find those one with low values of ATR, flat slope or positive slope, that are the one which should be traded long. I know that equity out of those combined classes is not that good. But that was just an example of with fantasy numbers for EMA 200 and the ATR period of 120 I used here. My gut feeling was to say I need a little bit smaller one, even if the charts are seem to be more noisy. Maybe it will improve my results. So let's have a look here to ATR, ATR 22 and an EMA of 50. ATR 22 has a little bit of a meaning like 22 is more or less exactly 1 month because we have about 22 working days a month. So that was the reason to go for 22 because I haven't done any optimization here. I simply use those numbers which, let's say, I like. And the rest is simply done by applying math, nothing else. We separate everything, and that was only the normalization process. And now our classes become much more obvious here, and you see a very fine and good short class now, which is not anymore the class number 8. It's now class number 4, which should be traded short, and you can clearly identify with your eye which class we should put into our basket. Of course, it will be the red one, the one. Of course, it will be the dark green one here, class number 3. We would not trade at class number 6, the even more dark green here. So if we combine those kind of results, we finally end up with an equity which looks like this. The absolute number we get here, that is the sum of all relative changes, is still about, in total, a 3, which is a gain of 300%. It's not that bad, because have in mind, we have not done any optimization. It was simply by applying that concept of class separation, looking to is there any preference within one class, and preference means long, short, or flat, and that's all. So there's no real optimization being done, and still we have already quite impressive results. So think about, we go even further down the road. We can use smaller time frames, which gives us more statistics. Here we have 6,500. If we go, for example, for H1 data, for about 10 years, we have 80,000 data. Then it might be a good idea to have more subclasses or even more indicators in order to get a better separation between the different phases, situations of the market. Or if we further go down the road to M5, then 10 years would end up with about 1 million candles. And then we might go for 3 indicators with 5 subclasses, which finally ends up in 125 class IDs, which will be analyzed separately, and then we get our rules for those specific situations. And to apply the same rules in the future, it's not complicated. We simply go for the chart, we look for the same kind of indicators, we know how to derive the subclass for each indicator, and then we know we look into our metrics and see how to trade. In this case, with ATR 22 and EMA 50, the matrix would look like this one here. And for me, in principle, it's astonishing that we have exactly in the middle now our short trades. But I don't question that because it's a pure outcome of our analysis. So why not? Now we would completely stay out of the market whenever volatility is extremely high, which is something I like intuitively. So I like exactly that kind of outcome here. And why not use that kind of information for our trading activities? So what does it mean? Finally, that is the table, and same table you find within the slides as well. So here back in the webinar, and what I have done here as well, I put the values for the separation on the slide as well. So those numbers which are used in order to get our three equal distributed values, and for slope and ATR, and the matrix itself is seen here as well. A few remarks additionally here. One, the shown equity on my last slide has in principle no stop loss and no take profit. So in this case, all the trades have been opened at open and closed at close of market. That's all. Of course, we can do it much more intelligent using stop loss, using take profits, but that is some further optimization which is still to be done here in order to get that strategy as a strictly rule-based strategy. Still, and I just want to emphasize that, we can use that kind of metrics already for intraday trading. If we identify in which class we are today, which means we look for the close value of yesterday and the indicator values of yesterday, and then we know what to do today, we can use that information of long day, short day, or flat day for our intraday trading purposes. That means we do trading, but we have a bias in a certain direction. And that already can enhance our trading results quite well. So that is another possibility to use those informations. That this can really be upgraded to much more and smaller time frames. Just an example, because that is something we put on live now exactly where we are. Here we are. On Friday, there was a test phase for that kind of strategy for a little bit, about half a year, a little bit more than half a year. And that's a strategy which is quite similar to what we do have done here today for DAX. Here it has been applied to Forex values, but on M5 base. And you see the trading results here for that kind of account. And of course, we have drawdowns, no questions. No question here that you have drawdowns still in your trading activities, but the result, I think, is not that bad. And therefore, we decided to put that originally demo strategy now on live since Friday last week. But that period is really too short in order to judge anything. I can show you the results, but it does not have real meaning. So right now it looks like this, but there's only 4 days of trading. So still, it's better to compare or to have a view here on this one, which is a longer history and really, really lots of trades. You see, trades per day here is about 70 trades per day, and that's at 150 days. So you can multiply those numbers. So the statistics behind that equity is quite huge. Yeah, so and therefore a decision is made, and the concept behind is absolutely the same we discuss here today for DAX Vola trading. And I hope, and that's already my summary for today, that you have learned a little bit more, that market phases can be really identified and separated via those classes. And we can use indicators, whatever kind, in order to create a measurement of the market situation with respect to those indicators. And if we use that class concept, then we have finally a set of classes which we analyze independently and separately in order to find out what kind of trading philosophy we should apply to a specific class. And with philosophy, I mean finally stop loss values in percent, for example, risk reward ratios, and so on and so forth. And those rules are assigned to the specific class and will be applied for the future as well. So that is how we can build up a strategy. We can use a simple one like DAX Vola trading, as presented in detail today here. But the concept is quite good for other underlyings and other kind of indicator combinations. Yeah, that's all for today. I hope you enjoy that kind of webinars, a little bit more methodology, not only the trading strategy itself in the focus, that you finally have a recipe like if that, then that, and do that. It's a little bit more of how to come to those conclusions and how to do it by your own as well. So if you have interest in slides, Excel sheets, those slides you can already download directly here, but if you want to have those Excel sheets, unfortunately, I cannot upload them here because there are limits, restrictions for document types I can upload, and Excel sheets are excluded. So just send me an email. You know my email address, s.friedrichowski@jfdbrokers.com, and I will answer as soon as possible as I can. Normally it takes, let's say, half a day. So tomorrow until lunchtime, you should have your answers. That's from my end. I wish you a pleasant day or evening, wherever you are, and see you soon in 2 weeks. The next webinar from my end, and my colleagues do a lot of other webinars all around the day. You know, and you find out at JFD Brokers. Okay, bye bye.